Hi, my name is Eric McCardle, Managing Director of Advisor Solutions here at Simplify Asset Management. Today, we're going to break down our latest blog, Demystifying Equity Market Neutral Investing, authored by Simplify CIO and co-founder David Burns. The 60/40 portfolio, the bread and butter of today's wealth management industry, is limited to just two core drivers of returns, equities and bonds. But is there someplace else that we can turn to for a compelling yet distinct source of returns? There are several places to look, with one of the most interesting being equity market neutral investing. Equity market neutral strategies can provide a source of absolute returns that are distinct from equities and bonds, as well as offer diversification benefits in the event of an equity tail event. How do equity market neutral strategies work? These strategies begin by analyzing a large set of factors and identifying a short list of factors that have predictive value. A basket of stocks with the highest predicted returns according to these factors become longs, while a basket of stocks with the lowest predicted returns become shorts, with the resulting portfolio having zero net exposure. To understand how these algorithmic strategies work, it might be helpful to take a closer look at just one of these factors by way of example. Let's take a look at the return on equity, or ROE factor. ROE is a concise measure of how efficiently profits are being generated by a company. It's often a good predictor of future returns, as high ROE stocks generally outperform low ROE stocks over long-term time horizons. This chart shows the performance of a portfolio that is long the 20% of stocks in the MSCI World Index with the highest ROE and short the 20% of stocks with the lowest ROE. As you can see, this factor performs well over time. We can improve the effectiveness of the ROE factor even further by being tactical with the exposure. This is accomplished by considering the seasonality effect, particularly in the month of January. This chart shows the same ROE factor, but this time pivoting out of the factor in January and replacing it with a reversal factor, in which the basket is long the 20% of stocks that had the worst returns in December and short the 20% of stocks that had the best returns in December. But aside from the potential for consistent returns, a major benefit to adding equity market neutral to a portfolio is its diversification benefits. These strategies often have low to negative correlation with the overall equity market, the very definition of effective diversification. Sticking with the ROE factor, we can see how a long-short portfolio of top and bottom ROE stocks in both US and global markets is negatively correlated to their respective long-only benchmarks, making it valuable not only as a return source, but also as an incredibly compelling diversifier to a broader portfolio. Lastly, how does the factor perform during periods of significant market drawdowns? This chart shows the performance of the ROE factor portfolio compared to the Russell 1000 index using the last two equity tail events, the global financial crisis on the left and the COVID market meltdown on the right. We can see that the factor had positive returns during both tail events. That's exactly the return stream that can add the most diversification value to an investment portfolio. Now imagine a portfolio that contains many such factors. That's equity market neutral investing. Once you understand how equity market neutral portfolios are constructed, you can appreciate the value that they can potentially add to your portfolio. Thanks for taking the time to watch this video. If you'd like to learn more about equity market neutral investing or other types of alternative strategies, please go to simplify.us. From the homepage, click the Contact Us on the menu, and we look forward to hearing from you.